Hello, everybody, and welcome. My name is Mark Newton. I'm the head of technical strategy here at FS Insight. I want to personally welcome and thank you for coming here to attend yet again another webinar that we're hosting. This one is a brand new product that we're just unveiling. It's called Upticks, and I'm going to be talking about really some of my top long stock candidates within many different sectors and discussing a little bit more about the methodology, how I come up with these names, and really we'll run through a few of them just to show you exactly what I'm looking at and why I feel they are particularly attractive. For those that are not, of course, FS Insight subscribers or part of Fundstrat, I do write a daily technical report every day and also put out a 5-minute video that talks about some of my favorite risk-reward scenarios across all markets. And so I would encourage you, if you're not a member, to certainly visit fsinsight.com or fundstrat.com and try to learn more about how you can participate and join. Many of you likely are already part of this process. And I've been here since September of last year, and we're just now getting around to putting out my long list. Of course, I've been doing not only daily updates and videos, and for institutional clients, of course, I offer one-on-one personal consultation and meetings and Zoom meetings. And, we talk about, really the best risk rewards of what's out there across all different parts of the risk asset spectrum, be it equities, cryptocurrencies, treasuries, commodities, and really what's most appealing and what's not. And so, this is an idea that came to light, and I named it based on Sir Isaac Newton, who not only was a brilliant mathematician and physicist, but also an astronomer. And he wrote a book back in 1704 about the corpuscular theory of light called optics. And so this is a variation of that, and it's called Upticks. Of course, it deals with stocks that I believe are technically attractive. And so I want to talk a little bit more about, some of my favorites and really how I came about arriving at the decision of why to get involved with these names and really how they're going to be managed. So this will be part of a portfolio. These are, what I feel are some of the more liquid parts of the S&P 500. It's not just going to be, small cap and illiquid names. It's really designed to capture, sort of the best of the best, and really names that everybody can participate in, given that they should have an ample amount of liquidity. But the large caps continue to be really an area that over time have been one of the best parts of the market to invest in until very recently. But I think that a lot of this pullback in large caps will be short-lived. I think that large caps in general are still one of the best places to invest. So I'll share my screen and you can sort of get a feel for, as I run through, the methodology and how I look at things. And so this is really a lot of relative strength is involved in this process. I'm almost always trying to screen for names that are at or near 52-week highs or 26-week highs, and you really find things that have a lot of momentum. I've been doing technical analysis for almost 30 years, and one thing I've learned over time is that it's really, although we as investors and humans like to buy value, buying low, selling high, in reality, the stock market doesn't work that way. And most times things that are at or near their lows are things that really shouldn't immediately snap back in mean reversion form. And so most times those aren't the best stocks to buy, the ones that have recently sold off on very heavy volume that one wants to immediately go and buy because of some perceived value. I think if 2022 has taught us anything, it's really that things that many of the investment community perceive as having good value per se, based on any of the different methodologies and fundamental analysis, it's become quite difficult when trends start to take over and we start to begin to see trends of lower lows, lower highs, that many times, stocks will far exceed or undercut these so-called fundamental targets, and really for no rhyme or reason. Many times you'll see that over time that stocks move based on sentiment and cycles. It's really not based on fundamentals per se that drive stocks, outside of short-term price movement. It could be caused by, better than expected earnings reports. And yes, you can get, above average volatility sometimes in the direction you want. But by and large, technical analysis really should be the basis for how one at least includes as a very important part of the stock selection process, even if it's not the top way of looking at stocks. I mean, I always encourage people to do their own homework, use fundamentals along with technicals, and when they both line up, then truly you can find a win-win situation, as opposed to just looking at fundamentals and not realizing that something might be in a violent downtrend and simply cannot stabilize when one wants to start moving higher. Stocks like Facebook or Meta, many perceive this year to be, an excellent value, and only now have people been realizing that has been very wrong and really selling out of the stock. It likely not the best time from a risk reward perspective. So with that being said, so relative strength is important. We want to find stocks that are at or near 52-week highs. We want to see positive momentum. We want to see moving averages that are upward sloping on multiple timeframes, not just a daily. Often I will look at the longest possible time frame possible and then gradually shorten it to really fit my time frame of investment. With regards to upticks, I'm going to be looking for stocks that I believe can outperform or show better absolute strength and relative strength on at least a 3 to 6 week basis. It's not going to be day trades. They're not going to be long-term buy and hold over the next couple of years. I certainly respect that trends in fact can change. And when we start to break those uptrends, it's going to be important to pay attention and to really manage risk. However, I leave that risk management to you and you only. I have come up with these ideas, and we're going to have support and resistance targets. But when stocks undercut levels of so-called support that I feel are important, I will likely be removing these stocks from the list. Now, it's up to investors to really make the decision as to whether you want to keep it or whether you want to leave it. And sometimes if support is broken, but structurally the stock still might be in good shape on an intermediate term basis, and I might decide to keep it. And I'll certainly relay that in my comments that I'm adjusting the support targets. So I've been doing this for about a month now, and fortunately, we've had a very good rally since the middle part of October. And so some of these stocks have hit these so-called resistance targets, and I re-released the update to this as of today. And so I've updated some of the resistance targets for the stocks that I like. I've gotten rid of a few names, and we'll discuss that. And I've also added a couple names. So that's that. Now, a couple other parts of the methodology. I use DeMark as a way of serving as a confluence of many different technical tools, but it complements the trend following mechanism because DeMark tools are very much counter trend. So if I see breakouts happening, but there's a plethora of DeMark-based exhaustion, whether it be, in this case, weekly and or monthly, and it's overbought, then I might decide to, take profits and get out of the stock, even though technically it might look very, very good. And so a lot of this very much is an art as well as a science. And it's difficult just to say, I can spit out all the names of 52-week highs and those are the ones I want. And that won't always be the case. And so I would encourage you to do your own research and find ways that you can, see how your own picks line up with sort of the way that I like to pick stocks as well. And the majority of the ones that I'm going to be choosing are ones that are outperformers to the S&P, as well as outperformers to their individual sector. And so all of those are really important when trying to find stocks that you think can outperform. I use Elliott wave theory. I think that wave structure is extremely important, and you'll see that many of my stops and or targets, but in the way I'll phrase it for the purposes of the report and for FINRA, of course, is support and resistance. This will be simply something where one wants to, obviously use the former highs and lows as being very much something that can be very significant, and that former highs are exceeded, and many times that can drive the stock materially higher for really no rhyme or reason fundamentally. And so, I started out reading William O'Neill's How to Make Money in Stocks in the early 90s. And, one thing that struck me right away is that when you look at the performance of the best performing stocks of all time, they all shared one particularly important trait, in that before they went up 5, 10, 20-fold off their lows, they all moved to new all-time high territory. And that's something that, investors from a fundamental basis might often avoid. They would say, well, the stock has gone up and I've missed it. And as the saying goes, sometimes when the horse gets out of the barn, you have to chase it because it's not coming back. So I tend to use that in my methodology. I always try to find stocks that obviously are acting well. And when that starts to change, then I myself will change my own thinking and remove it. There have been countless studies that have been written on the benefits of momentum investing. And, for me, it's not necessarily always buying the highest flyers. As you'll see, I like to buy stocks that are oftentimes basing at or near a 52-week high. So these won't be the strongest stocks out there always, but they will typically be stocks that have had a strong intermediate term run and then have begun to base sideways and then start to move right back out to new all-time high territory. I think that's a really important trait that investors can use to really increase their own profitability and portfolios, is to oftentimes gravitate from the ones that are showing, say, for example, RSIs over 85 or 90 on a monthly basis when they're overbought and they have DeMark sells, and move into stocks that are basing near their highs that are just starting to break out. And many times those become a much better risk reward for how to position. So in general, there's a lot that goes into this process. It's much, much more than just spitting out a list of technically attractive names and saying, all right, I want to be in this month and this the next month. And it's more about there is a process, and it really starts with finding technically attractive sectors. And then from there, stocks that are at or near all-time high territory that are acting very well. And unless this sector is going from a period of severe underperformance to suddenly gaining traction as one that performs well, as I said, normally these aren't going to be bottom feeding type candidates. I think that those traditionally are only tactical longs. They can work for a short period of time, but they're not great buy and holds because they'll have a good 5 or 10% move off the lows, and then they'll come right back down and test the lows. Ones that traditionally tend to rally, uninterrupted, are those ones that are at or near all-time highs, where minor pullbacks are certainly viable, but ones that tend to trend. And that's what we're looking for, stocks that trend. So all of these concepts are important. Elliott wave theory, DeMark, or lack of exhaustion with regards to DeMark, bullish bases, not only buying stocks that are breaking out to new all-time highs, but buying ones that are within short-term downtrends as part of longer-term uptrends. And that's another key concept. So I certainly don't mind buying weakness, but normally it has to be within the constructs of, okay, long-term uptrends in very good shape. Now it's weakened substantially, maybe in the short run, but the long-term trends are in great shape. So, short-term, maybe it's trending down, but hasn't caused any structural damage. Finally, occasionally I do pick stocks that are at or near 52-week lows that have been basing for some time, and I believe are sufficiently exhausted on the downside, and it might be trying to turn back higher. I think there's also a lot of value in that. However, I think you have to be a lot more careful with these stocks. And normally, after the first big move off the lows, one might want to reconsider and or get out of those stocks and get into other ones. Two key stocks that we'll talk about today, both of those were part of the Upticks list initially. And, one was Freeport-McMoRan, which I've decided to remove from the list. I think a lot of that recent strength was caused as copper was moving higher, as the dollar was pulling back, and also yields are starting to roll over a little bit. And of course, yields have been difficult to really roll over. They've remained pretty resilient. But now the dollar is at or near-term support, and I think we can have a move back higher in the dollar. And I think some of the precious metals and base metals could be in for a rough stretch. So my thinking is that Freeport is likely a great buy and hold candidate for years, for those that believe in the intermediate term cycle of what copper can do with all this attention being paid to EV. And I think, when you go that direction, you certainly need a lot of copper to make that work. And, we've heard stories about the CFTC and, for the first time, people are net long copper on the commercial level. All of those are important. They all go into my decision process as to why I would even consider a sector or a stock that's at or near all-time lows that is gradually starting to base and start to turn higher. So let's talk first of all about the list, and then we will go over really a couple of the new additions and some of the deletions and why. So within the healthcare space, Regeneron is one of the ones that I like long here. Healthcare is a phenomenal sector, and I also picked Humana. Humana's done very, very well. Let's start with Regeneron. So this just goes to show you the long-term structure, and I often, this is a weekly chart, and it goes out really over the last 5 to 6 years. You see the extent of this structure and why the stock looks so attractive here. And really, despite the market downturn, we know that healthcare has done very, very well. Really, the first 5 months of the year, it did well. It had a brief minor reprieve or a pullback, and now healthcare has started to break back out to new all-time high territory. And so, relatively speaking, it's broken out recently to new, really multi-month or multi-year highs in relative terms. So that's really important when looking at a group like healthcare. I want to show you just real quick, when I look at groups like healthcare, or why I would consider stocks from this group, even though they might seem like they're trending down over the last year, look at the relative chart of how healthcare has done versus the S&P in equal weighted terms. Just in the last month, we've broken out to really the highest levels we've seen since late 2020. So that's an impressive move. That's something that I really like quite a bit, and is a reason why I do like this sector to continue showing excellent strength. The healthcare is one of my top sectors right now for Q4. The other one, of course, is energy, and many know energy to be a strong sector, but we see that energy in relative terms has just broken out above May highs. So this puts it really at the highest levels we've seen in almost 4 years, relatively speaking. So many say, oh, energy is overdone and we're going to see a mean reversion. And that might be true, but based on pure technical strength, energy still remains one of the best sectors to own right now for outperformance. So I think that's also interesting. I'll introduce a third sector only because I recently have made some changes, and I have started to increase my weightings in things like industrials. Industrials have moved up really rapidly in the last couple months. And this is not just your large cap GE and Boeing. Of course, those have been important and they have been leaders, but it's really on an equal weighted basis. I always look at sectors on an equal weighted basis versus the S&P. And you see the way this just moved up above highs from last spring. And it also has surpassed the entire trend going back since before this chart. You can even see it. So it's at least as high as we've been in the last 5 years, relatively speaking. And that's really, really important. So yes, you do have the transportation stocks, and I pointed that out as we're entering the month of October. This is the reason why the market can bottom. Some of these leading sectors are showing much better strength off the lows. We see the aerospace and defense stocks acting well. And of course, with the ongoing Russia-Ukraine situation, we do see a lot of pockets of strength in many of the different aerospace and defense. And so, this sector stands out for a lot of different reasons as to why one would want to own it. But let's start initially with just Regeneron and talk again about, what this stock, where it's been, and why I still feel like it's excellent and can move higher. And that you do see, very good volume. Most recently, back in the early part of September, we saw the big movement higher on a weekly basis. And, it has stalled out a little bit the last couple of weeks, but you think about what the market's done since the middle part of August, it's been, abysmal. When I talk market, I mean, just looking at the S&P or many of the index gauges. So, it is important that we're seeing the stock hold up at or near all-time highs at a time when markets are in lousy shape. Humana is another one. Now, this is a stock which, I included in the first version last month, and it had a huge breakout. And this really goes back since 2020. So this is the one that, had already broken out. But as of early October, we really had not made that much progress above that all-time high, even though it was holding those gains. That normally is a very bullish signal. Many times stocks will make these sort of cup and handle patterns where they'll break out of a large long-term base. They'll move sideways and then they'll push higher. Well, that's exactly what happened to Humana. You look at this churning really since July, and now look what happened back in October. This is just 2 weeks ago when the stock really, really surged. So I have no reason as to, want to sell the stock, given that we got in at very good levels and it's acting well. This remains, one of the technically strongest within the entire sector. Yes, we are getting overbought on a weekly basis, but yet really no evidence of any counter trend sells as to why one would want to avoid it here. So really any pullback for me would be a chance to simply buy dips and think that the stock remains in very, very good shape. Let's continue on with a few more. And we will just look next at O'Reilly. And, O'Reilly has been a phenomenal candidate. Also, this is one of the strongest stocks within the entire, looking at consumer discretionary. And this whole space has just been on fire of late, at least selectively some. And so this stock in particular, when you look at the performance and why it's shown such good strength, you notice that, you look at it here at 8:30. This is a really a textbook example of the so-called cup and handle pattern after a lengthy advance. So this gives you some good insight as to what I like to see when I'm looking for a stock that I feel not only is technically sound, but one that can start to continue to outperform in the future. So some might say, oh, well, it broke its uptrend, therefore it's a sell. So yes, we did see above average volume. But in the bigger scheme of things, we barely got back more than 50% of its move just from, say, 2021 alone. And so when you look at it, really it hit, right around a 50% retracement. But look at the action really just since April of this year and what happened. And this is really important, and that we showed a large cup and handle pattern and just started to break out, and volume started to accelerate yet again, and then we gapped on even heavier volume. So the stock remains overbought, but it remains really technically sound at a time when markets are truly grappling for direction in the short term. With the election as of yesterday and CPI coming up, but no real evidence as to why one would want to avoid a stock like this. And it remains very strongly trending higher on multiple time frames, recent gap, heavy volume. Any sort of pullback likely would hold this area, but I would choose, since we bought it, really at much lower levels. And really, my first list was introduced on October the 5th. So we ended up getting into the stock right around 7:30, right ahead of the breakout. I'll set stops at 800. I think that in general, any move under 800 likely would cause us to fill the gap, but even it could pull back here. So much of this depends on your risk tolerance as to whether you obey these support areas or not. But as always, I have to leave the risk management to you. Lennar is another one. So this is interesting in that, we saw horrendous performance out of semiconductors, out of really some of the transports into October. But really, you look at what's emerged since June, and you see that Lennar bottomed out at 60. It made a big breakout of this downtrend, and even with rates elevated, the builders have acted far better than expected. And so Lennar is one of those stocks that is outperforming, its sector. And you see this recent move just in the last couple of weeks of the stock moving to the highest levels we've seen really since the latter part of August. So this is a great candidate to consider buying dips in that really has a stellar long-term base, and really, as with many others that pull back, it really didn't give up more than 50% of what it did since 2020, and now it looks to be starting to turn higher again. So if rates start to roll over, which I expect can happen in the months ahead, I don't think we're going to just go straight up in rates. So I think that is going to benefit the home builders, and really is a key reason why I want to hold this name. On semiconductor, ON, so, a lot of carnage in the semis, but this is one in particular that stands out as being very, very good. And I note that, even on, we just managed to recently move back to highs back in August. You look at the choppy consolidation type pattern, these normally aren't tops when you see these overlapping swings from an Elliott perspective. And now this recently just pushed back to highs. We pulled back, granted in the short run, a lot of the stocks within technology remain quite dicey, but ON is one that certainly I don't mind owning. Even here, the choppy consolidation of this pattern means that, this likely should move back to new all-time high territory. Now, it's going to take, with the S&P, certainly some stabilization in semis and really stabilization in S&P. But if I'm going to own tech, this is one that stands out. So one wants to really own this, and you could certainly even add to it over 68.54, which is really the late October highs. MPC, let's talk energy for a minute. So this, one of the stronger of the candidates that I look at within the entire space. Really, really good. Acts very well. Got into this right after the breakout. No reason to really want to avoid it. I know crude's been weak the last couple of days, but this simply acts just outstanding. And it's just really been a good name. So very difficult to avoid. Another one's Hess. Also a very similar situation. A lot of stocks are at or near 52-week lows. This one, broke out of a huge base. Even on the volume today, yes, the stock is down. Most of energy is down. But, the volume is about 1.5 million. It's really minuscule compared to when it more than doubled on early November. And so that's really a key, way of really judging sometimes whether a decline can be significant or not. And yes, it is at multi-day lows today, but, a bigger picture on an intermediate term basis, the stock remains in excellent shape. And yes, I like it. Another one is General Mills. So you look and really the stock pattern sort of speaks for itself. It's really one of the finer acting stocks within the staples area. And you see that on a long-term basis, look what happened just in the last few months. We've actually broken back above peaks going back since January 16. It's almost always important when you see these long-term breakouts. You look at stocks that over the years, like Microsoft, Amazon, back in 15, 20 years ago, and how did they really start to accelerate is when they broke out above like a multi-year base, and this is doing precisely that. So this is very, very good, and I still like it. I would use any sort of dips to buy this stock. Let's look at Monster Beverage. Now, this has recently come to life, and yes, we got in right as this little mini, as I would view it, a secondary shoulder pattern was happening. So yes, what I would call a reverse really head and shoulders, and that really can't be confirmed until we get up above, almost $100. 99.81 was the highs. But I love this structure, the fact that markets haven't been doing well, and you see a stock like that that's managed to really consolidate right near its 52-week highs, show excellent structure. A lot about how I'm finding these is not only looking for strength, but looking for stocks that are holding within 1 to 5% of all-time highs, and looking for ones that are basing for a period of time and that have the potential to really break out. So this really fits the bill for me. In the last couple of weeks, we see this big volume that happened just last week. Was the highest volume we'd seen in the stock really since August. So that's really encouraging towards how I look at things. And yes, near term, it does look to have hit, some minor resistance right up near former highs. Oftentimes that can be important. It's even doubly so because the stock has made several different peaks in that range. The more times an area is hit, though, as we know from technical analysis, the greater the chance that eventually when it does break out that it can really move meaningfully. But yes, it has been hit a number of different times. That makes it important yet again. As Gann taught us, normally on the third or fourth test, though, of these important areas near trend line resistance, they can be broken. It looks like this time is held yet again. So one would simply want to buy pullbacks in this, and then really on any move back up over 100, that should really give it a lot of energy. And when talking about Monster Energy, that's exactly what you want. So let's move on to a couple that I've recently added in this past month. And, United Health is one of those. And I really like this strength within healthcare. I think this stock has moved up, substantially in recent years, remains not only fundamentally sound, but really technically sound. It's had such a symmetrical, nice long-term uptrend, and that's really something that I'm looking for that I think can be of real value to investors. Now, it recently ran up, attempted to break out, it stalled out here. That's not necessarily a bad thing. That doesn't mean that it has to go back to the lows. This is just one of those stocks that likely is consolidating a bit as markets are weak. But I do feel that healthcare, having recently broken back out to new multi-year highs and relative basis to the S&P, that you really want to be gravitating towards the stocks that are at or near all-time highs, and UNH certainly fits the bill there. So, I like this stock. I added it, and I think hopefully it can work out well. The other one is PepsiCo, and this has been a consistent leader within the consumer staples group. And, staples, has come to life a little bit. I know that, parts of the defensive areas during this big stock market sell-off have not been all that great of late, utilities and REITs being two of those, but the staples area has been, much better when you look at the sector. And so I look at, stocks like that, and it just, I love seeing long-term multi-year uptrends like this in these stocks. And so, yes, it does need to do a little work, but as you saw on a weekly basis, what just happened 2 weeks ago. The stock broke back to new all-time high territory, and volume was expanding really in the early part of October. So those are key positives. Yes, I know the stock has been very choppy of late, really the entire year, but it's not a bad thing to be choppy at or near all-time highs when markets are weak. I do see this as a really a sign of strength. PepsiCo has been an outperformer over Coke, and I like buying Pepsi. Let's talk about the ones that I'm getting rid of and why. So Eli Lilly stands out as one of these. As many know, this has been a phenomenal success story within healthcare. Still, I like this stock a lot. From a long-term technical perspective, it's been a big winner, and I don't see why one wouldn't want to own it long-term. However, my concerns are a couple different reasons. One is that you're starting to see evidence of negative momentum divergence on a weekly basis. That's a problem. So the stock, when we got involved, was right down here in the low 300s. It's moved up to 370. So the stock has been up over 10%. It's one of probably 4 or 5 names that I own have been up 10 to 15%. And so it's just worth pointing that out, that now the stock has really run up to really the highs of its trend channel. And given that the stock has been so symmetrical, I look at that as being very important. And so, Eli Lilly is right up near 364. I'll share some additional reasons why I'm a little cautious on the name. And, some of that has to do with also DeMark indicators. And when I look at those on Lilly, you see that for the first time since the whole run-up, we have the presence of 2 different TD combo and TD sequential, 13 countdown exhaustion signals, along with a 9 count that happened this month. So it gives me reason to be concerned that we're likely going to pull back towards the bottom of this range. And I know that's a little big move, but it's something where, if I did that, then I would certainly look to add this stock back with really tight stops. So I do view Lilly as being not the best risk reward up this run up. And yes, we've owned it. And so it's time to, consider swapping this out with a name that's, at or near all-time highs. It looks better from a risk reward standpoint, like it can break out like UNH. Let's also look at PFG. Similar story. This is one of more just, finding stocks to really consider taking profits in after just a massive run up. And this one really is a great stock, but it's already had a huge breakout just in the last few months. And we see it went from 76 up to 90. So I love this long-term structure, but yet do I want to own it short-term over the next 1, 2, 3, 4 months? I have concerns just given the degree that the stock has run up. And I look at it as, up at 90, just in the last, month, it's gone up from 70 to 90. So it's been a home run. It might be a little too tactical to consider, getting rid of this and swapping it, but I'm certainly looking forward to owning this again on weakness. I just don't care for it here. I think that there's better money to be spent elsewhere. And if any sort of bad economic data comes out with CPI or anything that causes any sort of market decline under S&P 3700, then, names like this are certainly going to start to pull back. I'd also say the financial group has been a phenomenal outperformer, and now we're getting up towards the highs of the range for this whole group. So that's also a reason. I'll just show you a quick chart of how I'm viewing the financial sector, which has been a big outperformer. Now I think it's right to go more towards a neutral to financials, because I don't think we're going to get the same kind of upside for many of these names. Absolute basis are trending down relative to the S&P. We're right up near highs that were made back in the early part of this year, along with last year. So that's a key reason for me to say, okay, let's put on the brakes a little bit and expect that this likely can pull back a little bit. Finally, FCX. So this has been also one that I liked a lot, right down near the lows, and I chose to buy lows, but I don't really want to hold it long-term, given that I think the dollar is going to stabilize and start to turn higher. So I think this very well could start to pull back in the weeks to come, and I'd really like to preserve profits, of this portfolio. So in this case, I don't mind trimming that it's gone from 26 to 36, 25, 30% in a short period of time. I'd rather wait and buy dips. And yes, I do like the long-term breakout. So, you get a feel for how I'm looking at the world. And in a lot of these, the whole reason why I would buy a stock that is, near 52-week lows is if it starts to stabilize and starts to break out of longer term downtrends. That's a great sign. But bottom line, for the time being, this is just not a stock that I think is going to have a lot of upside in the short run. A lot of my cycles for copper show this potentially turning down into next year before the big move up happens. I do think copper is a great long-term buy and hold, but yeah, we have to manage risk, and in this case, makes sense to take some profits. So, net, that's a feel for sort of how I'm looking at the world. I do have resistance. I do have support. You do see, a sector summary in this, and it really goes through a lot of how I'm viewing different sectors and how I'm viewing the sectors. Of course, I like healthcare and energy is really my top two. And I recently added, industrials to being an overweight simply because I love the long-term breakout. And I think that's really meaningful. The dollar actually, could pull back in the month of December. It tends to be the worst seasonal month of the year for the US dollar. So, I'm watching certainly for that. A big pullback in the dollar likely would be good for risk assets, particularly if rates also pull back. And there's been steady, negative correlation between rates and U.S. stocks the entire year. So until that changes, one really wants to obey that and watch for evidence of, real rates starting to roll over. And that's going to be the real time to own the metals. And it's tough to say that we're quite there just yet. So I have to be very tactical on my metals. And so there you get a feel for how I'm looking at things. So I'm going to be adjusting this month by month and taking out stocks, putting in stocks. Of course, I don't want to give people, 100 names. It's very tough to manage. After all, I'm not a portfolio manager. I'm I do technical analysis here. And I write reports and I look at what I feel are the best risk rewards. But these are just a few of the names that I think are highly liquid that might be able to give you above average performance, hopefully in the long run. And so most of my time frame, I think, is pretty clear on how I'm looking to manage this and how I'm looking to set my resistance and support. And, just looking at things, you get a feel for how, many times if I'm looking at things, I'll establish resistance at or near, both Fibonacci targets. And Fibonacci, as one knows, are very important, not only in price, but in time. So they really mean very little unless time is aligning. But in this case, this hit, a 38.2% Fibonacci resistance area of the entire decline. And so many times, though, I'll use former peaks or troughs as being levels that you'll see as support resistance. And there's ample reason for why that can happen structurally. But, sometimes I do want investors to be able to stick with positions that are working. So if I still feel like the next few months are going to be great, then I'm apt to just stick with it. But for the time being, I'll just maybe raise support. And I've done that with stocks like O'Reilly. But other ones, I feel like it's right just to get rid of them and I'll add them back. And it's not that many stocks, so I can be a little bit nimble on how I take a look at this. So, overall, thank you very much for tuning in today. And I hope that gives you a little bit of feel for how I'm looking at the world and how I'm choosing some of these stocks. I definitely expounded a lot upon how I look at picking stocks. And, I'm not a day trader. I'm more of a swing or position trader, which makes my methodology a lot different than maybe some others that are looking at buying something for a few days on a quick breakout. And that's not really what we're doing here. We're looking for hopefully intermediate term buy and hold candidates. But yeah, at the same time, the market's a little dicey in the short run, and we have to respect risk and really choose to take things off or obey support targets if they're breached. So I'll try to be good about those. I am going to be, doing write-ups in some of the daily reports on when these have hit certain levels, and we'll talk about the methodology of why we're raising resistance, why we're lowering support, and if I want to keep it, if I want to throw it out. But there you have it, folks. Upticks, November 2022. I hope you enjoyed that. Have a wonderful rest of the day and enjoy, the start of the upcoming holiday season. I wish you success and happiness and good health through the holidays, and we will tune in again soon. So thanks and take care.